Welcome, everyone, and thanks for joining us for our third quarter call reports trend webinar. My name is Andrew Paolillo, and joining me today is John Kornacki. And before we get started, just point out in your panel, if you have any questions you'd like to submit, you can go ahead and do that. And as we get into the presentation, there will be a poll question, so you should be a pop-up and you'll be able to respond to that question. So what we're going to do today, what the agenda is we're going to go through three different areas. First, we're going to take a look at some of the key things that are happening with the yield curve and economic data. Then we'll take a deeper dive into some of the notable happenings that are coming out of third quarter call reports. And then lastly, we'll wrap up with going through some balance sheet strategies that depositories can be deploying to navigate through these challenging times. So without any further ado, I'm going to hand it off to John, and he's going to take us through the interest rates in the economy. John?
Thanks, Andrew. Good morning, everyone. So we're going to cover three main topics in this first section on interest rates in the economy: short and long-term rates, mortgage market conditions, and economic trends. So first off, we're going to take a look at various short-term rates. As you know, several months ago, the Fed came out and said, current levels may persist through 2022. That guidance has been consistent through every meeting, and the market has kept in line with that guidance. If you look at this table, you can see short-term rates have in fact grinded even lower than where they were in June. You can see that both the 3- and 6-month Treasury rates dropped 7 basis points, and the 12-month Treasury dropped 3 basis points. And then with SOFR and Fed funds, we see stable rates throughout and highly correlated. The data that we're showing here is month end, but when you look at the daily rates, these have moved in lockstep throughout. And really the story here is with the short end of the curve, with all of the market noise over the last quarter, the short end is quiet. And we're going to come back to this a little bit later in the presentation when we talk about strategies and how you can use this Fed guidance and the short end of the curve to your benefit. So on the other hand, with intermediate and long end rates, we've seen some volatility. The chart displayed here is looking at Treasury yields from June 30th. As you can see, we've seen a steepening here with the 10 and 5-year rising, more so than the 2- and 3-year rates. This is largely driven by strong equity market performance, reflation hopes, and a lot of optimism with vaccine news over the last several weeks. If you think back to 2010, when short-term rates were anchored at 0, today's environment is very different. The curve was much steeper in 2010. And even with the steepening we've seen over the last several weeks, and with much more positive outlook with hopes of returning to normal in 2021, we're still seeing considerably flatter than historical levels. However, it's not unreasonable to think that the Fed would allow the long end to drift higher while still keeping short-term rates at 0. And in terms of adding asset duration to your books, there's some better entry points now versus a few months ago. Whether it's commercial real estate or investment options, there is ability to add asset duration at better relative value. Now that's still subjectively low, but that's hard to it's hard to continue to compare to last year as we're not in that rate environment anymore, and frankly we don't know how long it will take to get back to those levels previously seen. So when there is relative value, it's certainly worth considering adding to your balance sheet. So we're going to look at mortgage rates first here. This chart you're looking at is showing the 30-year fixed rate mortgage and the 10-year US Treasury. This is going back to the end of March. Normally, the 10-year Treasury drives mortgage pricing, but as you can see from this chart, that hasn't been the case in recent months. And if you go back to mid-summer, the 10-year Treasury bottomed at 59 basis points, but since then has gone up over 30 basis points. And during that same time, mortgage rates went in the other direction and kept tightening. breaking through 3% towards 275. And we'll discuss in the next slide, the historically wide mortgage spread allowed this to happen, which technically shouldn't be the case in normal circumstances. And that's the treasury rates rising and mortgage pricing rising alongside. So as I alluded to, we're not going to take a look at mortgage spreads. In this chart, the gray area represents the amount of MBS held by the Federal Reserve. The green line represents the spread between the 30-year fixed rate mortgage and the 10-year treasury yield, with the dotted line being the 2019 average spread. The spread between the 30-year mortgage and the 10-year treasury, it's seen as a barometer in measuring value in mortgages as well as in pricing MBS. And if you look at the gray area, you can see massive growth in the Fed's MBS holdings, which has kept MBS prices high and spreads tight. And as the Fed's purchasing ramped up and continues, loan spreads had to tighten towards historical levels, as you can see by the green line. If you picture back to the previous slide for a second, where mortgage rates and treasury yields moved in opposite directions, spreads tightened independent of the rise in treasury rates. So as lender capacity was rebuilt, we saw this tightening and continue to see this tightening. And we may continue to see this tightening, especially as originators become more efficient, as refinance activity slows and capacity opens up. You still have a significant amount of borrowers in the money to refinance. And with the Fed appearing to stay in the mix as an MBS purchaser, there's a lot of factors that would contribute to tighter spreads independent of treasuries. So we're going to briefly look at a few qualitative assessments of businesses and consumers. The chart on the left is looking at both uncertainty and expectations for sales revenue growth. As you can see, expectations for sales growth dropped at the onset of the pandemic, with sales growth expected to be negative. We've seen that tick back up over the following months, but not to pre-pandemic levels. And then with uncertainty, that still remains highly elevated compared to January. It's come down a bit since, but obviously businesses still have a lot of uncertainty over the next 12 months. And then on the top right, we're looking at consumer sentiment. We saw sentiment, basically fall off a cliff in March into April, and hover within a tight band throughout the following months. And when you look at the drivers of this survey, there is an increasing optimism about the overall economy. However, that's offset by purchasing attitudes. Future job prospects remain the top concern for those that were surveyed, with unemployment rate expected to decline at a slower pace in 2021. And then lastly, we'll look at personal savings rate. That reached all-time highs in April with all the stimulus and significant reduction in spending. Consumers were able to build up a sizable rainy day fund. That has continued to come down every month since, but still above historical levels. As consumers become more confident and spend more, as well as if there's another stimulus, that will have a large significant impact on that savings rate. So overall, it's a bit of a mixed bag. You see some positive signals, but you also see a lot of unknowns, and those show through for both businesses and consumers right now. So the last slide in this section is looking at the Senior Loan Officer Opinion Survey on bank lending practices. Similar story to the economic data, there's some recovery, but still not normalized. In looking at this chart, you can see the net percentage of banks tightening lending standards across different segments. Lending standards began to stabilize in the latest quarter after standards tightened last quarter. Fewer banks reported tightening on commercial, industrial, commercial real estate, and personal loans, although most banks kept standards unchanged. But if you look at this in terms of consumer versus businesses, you can see that overall consumers are perceived as doing better than businesses, which does make sense intuitively. You know, if a consumer has a stable job and continues to throughout the pandemic, they may actually be doing better through not spending as much and having a higher personal savings rate. And then for businesses to do well, they obviously need revenue and activity, which requires customers to have jobs and spend money. So it will likely take more for businesses, for business lending standards to reverse, especially as expectations remain dampened and uncertainty remains high. So with that, I'll turn it back over to Andrew to talk through call report trends.
Thank you, John. So in this section, we're going to take a look at 4 key areas. Those being things that are impacting liquidity, yields and margin, the funding mix, and then also an outlook for going forward. So not much of a surprise, in terms of our conversations with members every day, is that the elevated cash levels are front and center in terms of concerns. So I wanted to take a look and see how drastic the change in cash levels are versus a quote unquote normal environment. So looking back at 12/31/19, considering that to be a normal operating environment, we looked at how many members, banks and credit unions, had more than 5% cash or more than 10% cash. So above 5% cash was about a quarter of banks, and for credit unions, it was just about half of credit unions. Now, as of 9/30, those numbers have exploded to 2/3 to 3/4 in the case of credit unions. So a significant jump in cash levels. And then even when we look at that 10% level, there is significant increases in the amount of cash on the balance sheet. So, truly incredible shifts here for a normally boring and stable part of the balance sheet. So the chart on the bottom, isn't the greatest visual for this format, but I'll give you some insight into 2 things that jumped out as we dug into the data. And the first one is that there were so what we're looking at here is the cash to assets ratio at the end of the second quarter on the x-axis, and on the y-axis is the quarter-over-quarter change by the time that we got to the end of quarter 3. So how effective were folks at spending down some of that elevated cash? And the 2 things that jump out is that there were a fair number of folks who were able to chip away at high cash levels. They were able to decrease by 3, 5, 7%. But the catch was they were starting at already significantly elevated cash levels. So you may have taken cash down by 5%, but you were starting at 14%. So you're still left at 9%, which is high historically. Then the other takeaway is that even for the folks who at the second quarter were doing okay and had normalized cash levels, 3, 4, 5%, there still were a fair number who saw those cash levels tick up. So they started the quarter at 4%, and then whether it be continued influx of deposits or asset side pay down, those cash levels have now ticked up closer to 10% below, versus the 5% that they were at originally. So flipping to the next slide, okay, so great, everyone has high cash levels. Can we still have high performance? Can we still have a strong return on assets? So we took a deeper dive into breaking out, the banks and credit unions who had above 10% cash, but who were also able to produce an above average return on asset, and looked at what are the characteristics happening on those balance sheet and what was the driver that they could produce high ROA despite the high level of cash. So the 3 areas that we focused on, it makes sense intuitively that you need some kind of differentiator. So you have to have the ability to produce a very, very strong margin. You have the benefit of fee income, or you're very disciplined on the efficiency side of things. So when we looked at what was the bigger or more predominant drivers, what we found is in terms of margin, it wasn't as impactful for banks, and which was a little surprising to me when we dug into it. I would have thought that some of our commercial banks, with the heavy emphasis on higher yielding C&I loans, who traditionally have had higher margins, that there would have been something there, but it wasn't necessarily the case. But for credit unions, margin was very impactful. That those folks who had high cash yet still had high ROA had margin in excess of 58 basis points higher than the rest of the group. So I think that's attributable to some of the consumer lending activities. And we'll get to in a little bit about why performance was driven by lending, not by funding in the recent quarters. Fee income was impactful for both banks and credit unions. That's attributable, no surprise, to the heavy mortgage volume activity that we saw in the quarter. And then efficiency played a part for both banks and credit unions, more impactful for banks in terms of the difference in the efficiency ratio versus for the high performers versus the rest of the crowd. And I think that's attributable to size differences, as the average asset size for banks is a little bit larger than credit unions, so it's a little easier to spread that the cost across higher cost bases. So continuing with the liquidity theme, and also the unconventional environment that we're in, we'll take a little bit of a look at what's happening with the PPP side of things. So as many are familiar with, the PPP loans have largely been self-funding, in that the proceeds were distributed to customers, and a large percentage of those balances have remained in the checking accounts. So when we look at the usage ratio of the Federal Reserve's lending facility that they've put out for banks and credit unions to be able to access, the usage ratio, at least in New England, has been very low and lower than the national rate. So about 7% of our members are utilizing the facility versus the outstanding amount of loans, which is a little bit lower than the national level. So it just gives you a perspective on how self-funding that these really are. So, my thoughts on the PPP loans, in terms of, everyone's talking about the forgiveness and what is the timeline and the amount of the forgiveness going to be. And, from think about it from the customer perspective, that this loan at 1% is just about the cheapest insurance policy for the uncertain economic climate that John talked a little bit about before. It's the cheapest insurance policy that they can ever have at just a 1% rate. So, whether the forgiveness comes or not, I would expect to see the balances stay in the institution. And so when you think about the elevated cash levels right now, that the loans switching to cash, if and when forgiveness comes, is only going to compound the liquidity and cash challenges. So, moving on from liquidity to margins and earnings, and now we're going to try out this poll question here, and I'll ask everyone to vote and see, relative to the second quarter, what percentage of FHLBank Boston depository members improved their net interest margin in the third quarter. So we'll give it just a minute or two for some of the guesses to come in. Okay, they're coming in, and okay, I think we lost our place on the spreadsheet, so just bear with us here. So the poll results were 48% of you voted 20%, 30% voted 30%, and 14% at 40%, and then 9% thought that half of members were able to expand margin. So about 40% of our bank and credit union members were able to expand margin in the quarter. So kind of interesting. So in terms of what is driving that margin expansion, we took a look at some of the analytics that we've developed. So we've created this the system where we can look at a number of different metrics and create these things that we're calling loan quality score and deposit quality score. So it's looking at the size and the composition and the rate of the loan and the deposit portfolios, and it produces a relative score from 0 to 100 versus either all the other banks as well as the other credit unions. So what we saw is that for the chart on the left-hand side, is that for those members who saw an expansion in margin in the quarter, that it was driven by the lending side of the house. So it makes sense intuitively that we're in this period of high liquidity, that the folks who are able to get that liquidity out the door, turn it into loans, were most successful, and we're able to see their margin expand. And we've developed a similar approach with asset sensitivity, so creating an asset sensitivity score, and we saw a similar trend, but maybe to a less impactful nature, in that there was a slight tilt towards those who had greater liability sensitive characteristics on the balance sheet. So the things that we're looking at, the types of loans on the balance sheet that tend to be more of shorter durations, and also the deposit mix from non-maturity versus time deposits. And so there was a little bit of a bias, slight bias towards those who were liability sensitive, those folks seeing a greater expansion of margin. So moving to the next slide, looking at how the yields on the asset side of the balance sheet changed. And we saw pretty sharp drawdowns in investment yields, about 21, 23 basis points for the median bank and credit union members. And I think there's an asterisk there, right? Because going back to those elevated levels of cash, that normally, if there was some more attractiveness in the normal investment options, that those would have been redeployed. So that would have led to a greater decline in those investment yields. Looking at the loan side of things, credit unions were a little better at preserving yield. So at each percentile, so whether you're talking about the 10th, 25th, median, 75th, or the 90th, credit unions were able to either have less contraction in yields, or even in the case of about 25% of our credit union members, able to see some expansion in yields. And I think the thing that we can point to there is that while the reliance on auto loans typically leads to shorter loans, shorter average lives that you think would normally compound reinvestment in this type of low rate environment. But despite the shorter durations, there's less prepayment risk, certainly versus the residential and even the commercial side. We've talked with a lot of banks who have seen an uptick in prepayment activity, even on the commercial side. So that has led to some of the contraction in the yields. So when we think about investing the excess liquidity, so almost across the board, liquidity, however you define it, is significantly higher than where most CFOs and treasurers would like it to be. So the question to ask is, has anyone been able to get to a normalized level of liquidity? And the answer to that is yes, but just about under 20% of them. So if you look along the left-hand side, we're looking at the breakout of members who have been able to decrease investments as a percentage of assets, as well as decrease cash as a percentage of assets, which would take your liquidity portfolio and be shifting it into loans, what depositories are trying to do. So that number was pretty slim, under 20%, considering that we were operating off of this base of extremely high liquidity. So the middle two sections just show the shifting between the two categories of investments and cash. And what we did see is that banks were a little more successful in gritting their teeth, covering their eyes, holding their nose, whatever way you want to describe, buying investments in this low yield, low spread environment. That banks were a little more successful in taking that cash and deploying it temporarily into the bond portfolio, where credit unions were more inclined to lead to an uptick in cash. And I think part of the challenge is that many of the structures that are depository friendly when it comes to the investment side of things. So whether it's shorter durations or low premiums or taking some optionality with callable structures to get a little bit of extra yield, because of the path of interest rates, those are the types of structures and features that have lagged in terms of performance. So it's certainly challenging, and especially in the backdrop of where the cost of liquidity is so high. So moving from the asset side of the balance sheet over to the deposit side, and the thing that jumps out is that the spread between deposit costs and wholesale rates, not only has it shrunk, but it's completely gone away. So as everybody here knows, that the value in the banking business model is the low cost, sticky funding that deposits, non-maturity deposits, can produce. So if we go back to the beginning of 2019, where rates were just starting to turn after a little bit of a hiking cycle by the Fed, that you could have bought a 3-year treasury and funded it with the average cost of a savings deposit at the time of 50 basis points, and you could have produced a spread of 200 basis points. So you're funding cheaper than where the U.S. Treasury can fund, which doesn't make sense to the layperson, but that's how, again, that's the beauty of the banking business model. Now where we are in terms of rates, not only is there no spread, is that Treasury yields are right on top of where savings deposit rates are, and so deposit costs have come down slightly, but you can see going from that 50 basis point range down to 25 basis points, there really are not many levers to pull in terms of lowering deposit costs when it comes to non-maturity deposits. Where there is opportunity is in the time deposit side. So you can see that loan X up along the right-hand side of the screen, and that is the median cost of time deposits at the end of the third quarter. So that is where the potential further deposit cost savings could come out of. So looking at the composition of the time deposit side of things on the next slide, there's two things that jump out, and one of them was happening before the pandemic hit, and one of them has and the other one has accelerated since over the last couple months here. And the first trend is that certificates and CDs were getting shorter, right? So going back to March of 2019, 60% of CDs had maturities under 1 year, and that was increasing, by about 4%, 2% each quarter going through 2019. So the upward trend was continuing, and then now today we sit at 72%. So there's more CDs that are priced at the shorter end of the curve. The other trend, which has been accelerated just in the last few quarters, is that time deposits have been decreasing as a part of the overall funding mix. And that makes sense intuitively. And we've heard that from a lot of members that said, not only have they not seen deposits run off, but they've seen a shift from maturing time deposits into non-maturity deposits. So, this provides the opportunity where you more than likely have a lot of your time deposits coming due, and doing nothing, whether you're aggressive or you're conservative, because of the abruptness of the fall in rates, you're going to be able to save on interest expense. It's a function of what is your liquidity position, and John's going to talk and go through an example a little bit later about where do you have to price these to recalibrate your liquidity needs, your earnings needs, and even your interest rate risk needs in terms of how you're pricing these deposits going forward. So shifting from deposits to look at what credit performance looked like in the quarter, and in short, it was pretty good. So looking in the top left-hand side, so what we've done here is create 4 quartiles by asset size for all of our members and look at some of the key credit metrics. So we have the 0 to 25th percentile, our smaller members, 25th to 50th, all the way up to the top quartile in terms of asset size of our members. So when we look at provisions were down in the third quarter after 2 pretty healthy quarters of provisioning for most. There was a little bit of a catch up for the smaller members who weren't as aggressive early on in terms of adding to reserves. Non-performing assets, again, unchanged to slightly down for most, a little bit of a tick up in the largest asset size bucket. Net charge-offs, nothing really to talk about. The stress in the market caused by the pandemic hasn't flowed through to actual loan losses yet, which is a good thing and speaks again to the measures taken and the overall health of the consumer and the commercial client. So in the bottom right, this is interesting in that, even though across the board charge-offs really weren't elevated, we did want to look at break it down a little bit further and look at where charge-offs were occurring and see if there was any differences in loan composition to suss out where some of those isolated incidences may be occurring. So when we look at those folks who had charge-offs in the top decile or the top 2 deciles of when breaking it out, we did see that those members had a significantly lower allocation towards residential loans in their loan book, and they did have a higher dependence on C&I loans. So in example, for all the way on the right, for those who were in the 90th percentile for charge-offs, they had 18% C&I loans and 34% in residential loans. Compare that to the median, the 50th percentile, and resi loans were 20% higher and C&I loans were half as dependent at just 9%. So, that tells you that, where there are isolated pockets of stress, it's more than likely coming out of the commercial side of things versus the consumer. So the last thing, we'll touch upon here is looking at the performance, the stock price performance of public banks. And I think even if you're a mutual bank and even if you're a credit union, it is useful to see what the broader markets are thinking in terms of banking as an industry and as a whole. So, this is looking at the year-to-date total return for the S&P 500, but also our median public bank member. And the theme was that banks underperformed at the onset of the crisis, declining more than the broader market, and they have been slower to recover. What is interesting is that we pulled this data as of November 6th, and as usually, as a type of luck that I have, the first day after that was the first of the fantastic news about the vaccine trials, where the market exploded higher. And then 2 days ago, we got another announcement. And again, the market reacted favorably. And I will point out one thing here is that while the banks have underperformed so far year to date, in these last 2 instances, on this positive news, that banks significantly outperformed the broader market. And it was also partly due to the fact that not only were equities rising, but the yield curve was steepening. So the market was responding favorably and voting that a steeper yield curve will benefit the banking business model, which everyone here pretty much gets. So the last thing in this section, again sticking with the valuation theme for the public banks, is that, the price to book multiple is a way that banks are measured. And, owing to that, that deterioration and the uncertainty in the credit performance and the low and flat yield curve that has presented challenges. As we sit here at the end of the third quarter, the best valued bank was very close to the valuation level of what the weakest banks were valued at going back into 2019. So the script has completely flipped. So despite that, I think when you look at the high and strong levels of capital, the high level of provisions that have already been built up, and then the ability for banks and credit unions to participate in a snapback economic recovery, while it may be a tough slog over these next few quarters, I think the industry as a whole is positioned to participate in this economic recovery and to not just get back to normal, but to thrive. So I think so for public, for mutual, for credit union, there is a vast amount of opportunity for things to get better. So that is going to wrap up this section, and I'm going to pass it back over to John. And he's going to go through some specific strategies.
Thanks, Andrew. All right, so we're going to finish off talking about a few different strategies here. So the first strategy is deploying excess liquidity. So when you think about executing on strategies, the best strategies are the ones that fit your balance sheet needs and offer some relative value on a standalone basis from a market perspective. Generally speaking, through looking at our depository members' balance sheets and through discussions with those members, we've seen higher levels of cash, higher asset sensitivity, increased margin pressure, and robust mortgage pipelines, along with choppy commercial loan demand, or as the lending survey would show, maybe less appetite for commercial lending. So if we take these balance sheet trends and challenges and look at market conditions, we see tighter MBS spreads, wider loan spreads, and stable funding conditions. When you consider balance sheet needs, along with those market conditions, there's opportunity that our members can take advantage of by retaining fixed rate mortgages. And we've been big advocates of holding fixed rate mortgages outright if it's appropriate for your balance sheet. So if you think about this from a break-even perspective, even with higher gains on sale, break-evens are at normal levels, roughly around 12 months due to the much wider spreads that we're seeing right now. The major difference is, given high levels of cash at institutions, the balance sheets need loans and margin help, more so than it did a year ago. And another way to think about this is creating your own investment alternative. So you don't like yield, spread, average life, or premium with MBS. So you replicate your own with a mortgage and cash barbell strategy. If you look at the chart on the left, we're showing a 4-year average life MBS with a yield of 1%. So if you want the same 1% yield, you would invest 35% in retaining fixed rate mortgages and 65% in cash. That gets you a yield just over 1% with an average life 1.5 years shorter than MBS, along with no premium risk either, so your yield can't go negative. And if you're okay with extending further out, you look at the chart on the right, we're showing 55% mortgages, 45% cash, which gets you 70 basis points more in yield, again, with no contraction risk. So as you consider, the limited investment opportunities along with, robust mortgage pipelines, this is something worth, discussing as an investment alternative, while taking advantage of your own loan demand. So moving on to the next strategy here, if you define liquidity last year and years before that too, I don't think you would have ever included too much liquidity as part of your definition. You would have said it's, not having enough liquidity or the potential to not have enough. But with today's current environment and the tsunami of liquidity, we have to tackle liquidity from the perspective of having too much of it. And we can tackle this from the asset or liability side of the balance sheet. Deposit growth has overwhelmed loan growth, which has led to elevated cash level and margin pressure. Continue to take a hard look at deposits and where you can reprice lower. We've heard from many members that have ratcheted down rates, both in absolute values, but also relative to other sources like advances, more so than they ever have. And deposits are sticking around, and that's non-maturity and term. And on the asset side, try to remove negative carry on your balance sheet. Paying out 25 to 50 basis points on deposits and holding cash overnight at 10 basis points is extremely costly. Revisit both loan and investment options and see where you can deploy that cash. So as I mentioned in the last slide, one way to look at deposit pricing is by using our advance curve as your benchmark. Every day that you can immediately access funding at a point in the curve of your choosing, not where there happens to be customer retention. So when you look at your liquidity position, what levels of deposit retention do you want? And what can you handle given your asset options? Push your rack rates low while balancing the qualitative aspects, but retain flexibility for exception pricing. And as Andrew went over earlier, Cs have been shifting shorter, and banks and credit unions have done well with rate movement. But now the question is it time to pivot from focusing on the short end and try to push further out? Historically, there hasn't been much demand further out, especially in low rate environments like this. But if you were able to bring in a 3-year CD, could that afford you some flexibility in looking at longer assets than you otherwise would have? Certainly something worth discussing as you manage your balance sheets. So what we're looking at here is the Fed dot plot. This is the Fed governor's expectations for what the target rate will, what it looks like in the future. The Fed has always tried to be transparent as possible. So the dot plot is a way to be transparent both visually and quantitatively, with their thoughts on rates. If you look at this chart, you can see short-term rates are not expected to go anywhere through 2022. Only one loan governor put their expectation at 50 to 75 basis points. Everyone else expects the current level of 0 to 25 basis points. And then if you look at 2023, you still have 13 of 16 remaining at the same 0 to 25 basis point level. And as we talked about earlier with the first two slides, that's consistent with what short-term rates have done, and intermediate and long-term rates are driven by different market forces and can fluctuate outside of that. There's short and medium-term windows where it pays to be opportunistic, further out in the curve, and other times when it pays to wait. So, how do you fund in a way that aligns with, what the Fed is doing and saying in terms of rates, but you can benefit from avoiding any short hiccups in the markets that long-term rates provide you? So the answer is floating rate funding is what gives you that profile. So what we're looking at here is a simple funding strategy, equal weight SOFR floater at 3, 6, and 12 months, and a 1-year, 1-month DNA floater. The SOFR floater reprices daily. As we saw earlier, SOFR and Fed funds have an extremely tight correlation, and the DNA reprices on a monthly basis and gives you the option to pay it down with no penalty at every monthly interval. So what you get in this profile is cheaper funding than classics at the short end, reprices based off of the very front end, which is aligned with Fed guidance, but you have a maturity profile that is out to 8 months. So if markets become volatile and spreads widen, you'll avoid having overnight funding that will have to be replaced at an inopportune time. And the DNA has a nice benefit as well, because you can pay down the advance efficiently if you no longer require the funding. So this is something we've discussed with many of our members in recent weeks, and think there's a good opportunity to align with Fed guidance and protect against market volatility, if you want to remain on the short end of the curve. So with that, I'll turn it over to Andrew to close us out.
Thank you, John. So just want to say thank you to everyone for joining us today. And if you have any questions, or if you'd like to see any of this analysis tailored specifically for your institution, please reach out to us or your relationship manager, and we'd be happy to help wherever we can. So with that, hope everyone has a great day. Thank you.